Hello, welcome to Policy Pod by LDA. My name is Matt Gauthier, and I'm your host. This podcast aims to break down common trends, problems, and concepts in the life insurance market. We wanted to create a place where we could talk openly about the things that confuse both clients and advisors alike. This is part one of a two-part episode, where I was joined by Brent Swatuk from Gryphin Advantage, as well as Charlie Conron and John Jarvie. Brent spent an afternoon with us, and we discussed a variety of topics from building a career in life insurance to products and policies. And we hope that you enjoy it as much as we did. Brent has been in the insurance and advisory business for over 26 years. He has held various roles and has a multidisciplinary background across multiple large firms. Currently, he is the Vice President of Advisor Growth and Advanced Markets at Gryphin Advantage Inc., a national boutique MGA with an incredible history and culture. Brent is active with his local advocates chapter, the Gamma Canada Board, and he holds multiple designations, including the CLU, which he's most proud of achieving.
Brad, it's great having you here. So recently you've changed career paths and you've left carrier headed to an MGA at Gryphin Advantage. What caused the change and what are you excited about doing now at Gryphin at the MGA?
That's a big question. Opportunity. Opportunity was really the thrust here. I had spent the better part of my career at two major Canadian insurers. Great run there. Two great firms that we still do a lot of business with. But honestly, it was just timing and opportunity, on both sides of the equation. So Gryphin at the time was evaluating whether they would add an advanced case person along with someone that could do more of the coaching arm of things. And I was looking at it and saying, this was just a really good time and opportunity for me to make my depart from that side of the business over. It's actually back into the MGA because I went from MGA to carrier. And so back to the MGA. And really that was because I had been building coaching programs for a number of years at both carriers. That's something that's missing in the independent space. It's something from an independent level. So most carriers will create content, but it's skewed towards them. We're creating content now that's really skewed towards our advisors. Where do you want to go with your practice? What do you need to learn? Where do you need to go to raise up your level of leadership so that way your influence is at an all-time high? You're conducting business with whom you want to conduct business with, and you're converting more rapidly. So you're scaling at the level that you want to scale at. So it was partially that. There's a great allure that came with Gryphin for me. So it's a shop that has a culture. I don't think there's another MGA that really has a culture like Gryphin. So it was a really great opportunity to leave a carrier that had a really great story and culture that was there, but to join an independent firm that had an amazing culture, a growth culture, a very tight-knit community, and be able to see the impact that we could have there and then help them scale to where they want to go.
What were some of the biggest changes in your day-to-day going back to the MGA from being the carrier? Obviously, it's a different, animal, I guess, in the same hunting grounds, but
process-wise, not a massive difference. Most people that know me know that although I worked at a carrier, I'm kind of, because I came from an MGA, I always stayed up on everybody's product. I never wanted to be that guy that was like, well, you should sell our product because we're the best and they suck. And then somebody says, well, why is that? And then there's that pregnant pause that happens while I formulate something that may not be true. And so for me, it's like, I never said we were the best in an area that we weren't. I was very fortunate that I went to two carriers that have incredible product shelves that fit my marketplace extremely well. So it was never really a problem. So moving over, the biggest change is really not will I get the deal, but where are we going? Where do we put the deal after we get to all the facts onto the table and where the client wants to go? So that was kind of maybe the biggest shift. I won't say it was a pain point because I already knew everybody's product. So it was like, really, I sat down with all the carriers. Like I think first couple of weeks I sat down and I said, tell me what I wouldn't know about your product. Like, tell me what's really unique about your underwriting or your capacity, your retention, whatever. So that was that. But other than that, day to day,
do you feel like carriers are more willing to tell you all the secret sauce now that you're at the MGA level instead of the competition?
Yeah, I mean, so first off, carrier to carrier, none of us hate each other. Like, look, when you first get into wholesaling, the first 3 years, you want to slash everybody's throats because you think they want to slash your throat. And then what you realize about 10 years into that, it takes about 10 years, is you realize that you're not slashing anybody's throats. Like, there's more than enough business to go around. You might steal the odd deal, and you always feel good about that. I'm not going to lie. You do. You feel good when you win a deal, right? But like, I think you know where you play and where you don't play. So I don't think there was any of that. Will I say that were they more than happy to tell me? Yes. Fortunately, I had all the wholesalers we deal with. There was only a couple that I didn't have a relationship with.
Yeah.
So it wasn't tough picking up relationship. And really, at the end of the day, I think they actually kind of like coming and meeting with me because they didn't have to go through the entire product. It was like, yeah, I understand the chassis of whole life. Just tell me what your uniqueness is. Like, I understand like UL. Tell me where you're really unique and where you're winning business in the lens of who I do business with. So don't tell me about like something that you know is never going to fit me because I don't need to know that. And once again, I'm very, although I will interact with our people, I'm focused on high net worth deals, business owners, stuff like that. So don't tell me that you got the best severe burns in your CI contract because it doesn't move my needle any.
Mm-hmm. So like being non-biased to the product, were you wooed, I guess, or brought in by Gryphin, or was it other people trying to like have you come on board when you were deciding to like maybe move on from the carrier?
So I think, well, I mean, it was no secret. I decided I was going to leave. I had that talk with senior management at the firm I was with, and it was fine. But we left like we are really good, and we do a lot of business with that carrier. So
yeah, small industry, you're going to see all around.
Yeah. I mean, but you know what? They treated me like, honestly, they treated me so well. And even leaving, they treated me extremely well. And afterwards, treated me still very well. So there was another company that had approached me and wanted me to do what I had done at the other company for them because they're not in the large case space, but they want to start to really operate in that space. And I did look at that and did some research and actually learned a lot about this company I did not know. And that was cool. And then all of a sudden, like I was like going there. That's where I was going. Mm-hmm. Like it was pretty much a done deal, right? And then at the last minute, it's just kind of like weird. Like I'd had talks with Gryphin. Then, you know, like anything, like the talks go soft, right? And then all of a sudden, bam, we were back in talks. But like we're talking like days away from pulling the trigger and being somewhere else. And then we got together. I met with Rod and Kirk and Jamie and Cooper, and we had one lunch, and that was it. Like they made me, you know, the old Godfather. They made me an offer I couldn't refuse.
The Gryphin chemistry. Yeah, I think we're going to get a taste of that this year. We're going down to the Florida conference with you guys, the summit. John is going to come to the summit.
What can Gryphin expect to hear from you when you go down?
We're going to be talking a lot about policy lifecycle management. Obviously, LDA is known a lot for the initial sale, educating the advisors, and then also the very end of it too, when acting on opportunities. But there's a lot that can be done as far as cross-selling, finding cross-selling opportunities within the block of business, educating clients on their existing policies and keeping in touch with them too, making sure they're staying compliant, not just on the sale and the management at the end, but a lot of those middle parts in between, which are kind of lost revenue opportunities that we're seeing from a lot of our subscriber base are just people not using LTA. So we'll be talking about that and also some of the new features that we'll be introducing later on to LDA.
So I'm going to jump on that, even though it's kind of like we're just riffing here, but that's a huge thing. And actually something that I talk about a lot is the economic lifetime value of your client. So if we have a target market and we spend a lot of time building programs around them to onboard them into our system and they buy into the program, carriers are building products so much smarter than they have ever before in my history. I've been doing this since 1997. When I got in the business, if somebody bought a T10 from you and they wanted T20, it was like, tough crap, reapply. That's just the way it is. And now we've got exchange programs. But the problem is, and this is no shot at any particular advisor, what we don't do enough of in this business is scripting. And so some of us are like, well, we know that's a feature, but yeah, what's your script in order to move that 5-year exchange?
And did you sell it when you placed the initial policy?
Right. So you probably did, but yet you're waiting thinking the client will call me when the time comes. Like when we hit the 5-year mark and we can put the screws to them, but there's scripts that you can develop in that 5 years. So what you want to do is use software like yours to be able to keep that going on the annual reviews to show people the options that are coming up, because there's an economic lifetime value to every client that we have. And we know on average clients will buy 8 times, sometimes more than that if they own businesses and they have other needs, right? They have other losses that we want to protect. But on average, if a client's going to buy 8 times throughout their buying cycle, wouldn't it be smart to develop scripts and have software that supports that? So that way, we can capture them for that exchange when it makes sense. We can capture that conversion, right? For those companies that offer partial term conversions and stuff like that and refreshes on the term, your software works amazingly well for that. And it's one of those things that as an advisor, if you have not built that infrastructure, which let's face it, most haven't, that's the beautiful thing about your software is they can get in and they can learn to build scripts around how to use that software efficiently. So that way, while you're, acquiring clients is difficult, if you can take the clients you have and maximize all their buys as well as acquiring clients outside, then your earning potential is reaching its maximum point.
And I think you added a level of consistency there too. Like we have a lot of advisors, they'll do a T10 versus a T20, but sort of to your point earlier, I don't want you to buy the T10. I'd love to sell it to you. I'd make double the commission, but I don't think it's right for you. What I do think is right for you is exchanging it at the 5-year mark and then kind of illustrating that. So it's almost that asymmetrical document. It's like a little too hot, a little too cold, just right in the middle here.
Yeah.
But we actually built that feature on to show like right off the get-go to illustrate those exchanges and things like that because, again, hidden opportunity for advisors. I tend to think, again, on a different tangent that if they had, maybe incentivize those from a comp model, maybe a little different, they might see more take up from advisors.
True. But I think like the comp is the comp, right?
Yeah, the comp is the comp, but I think the process is the thing that advisors need to.
That's the biggest thing. That's the biggest thing. If you can create it and you can create a systematic process to it, it's not difficult to do. And you're like, if you had all of your terms, you knew in the next 5 years you were gonna do a 5-year exchange on some of that cover. That's business you're not having to go out and fresh hunt for, right? Like it's already kind of in the pen waiting for you to corral it sort of thing. So like that's huge.
Yeah, and I think half the time, like what we see with our advisors, even if they don't want the exchange, what happens out of the conversation when you say, hey, Brent, I just want you to know you have this opportunity for this. You don't have to take it, but it's there for you. That's great. It's not right now, but hey, I did really want to look at my CI, my DI, this, that. I mean, clients always have a million things going on. So even just to open the door and start that conversation, I think is a phenomenal one. But yeah, absolutely. Getting it in the routine and having something where, again, you can repeatedly put that in front of clients. Obviously keys to success and repeatability.
Well, it's funny. I know we're going to talk about this, but I'm going to jump ahead a little bit. On one of the forums that I moderate, somebody was like slamming like the sale of T10, right? They were like, it's laziness and they should just be selling T20. And I'm like, I'd rather see somebody maximize their human life value replacement than cheap out just because you could buy a better term. Like, especially given that, let's just say it's like a 30-year-old, right? And I'd rather see them max out their human life value or their income multiplier ratio. So that way, if God forbid, it's their day, they don't walk back through the door, their family has enough pot of capital to turn that into income so they don't have to, they don't have to die twice effectively, right? One, losing the father, the parent, the income earner, and two, then having to make very tough decisions for the rest of their life. So I'd rather see that get maxed out. And then knowing that 30-year-old over the next 5 years, unless they're just the one person that doesn't think they're going to advance their career or earn more money, which probably doesn't fit my target market, right? But like, I'm going to have 5 years in which, you know what, as your income grows, there probably is a better duration in here that you should own, but better that you have the proper amount of income replacement ratio on your, like on death or disability or whatever, than it is for us to, you know, have the better like time duration, you know, just me.
I mean, I just went through the insurance process myself, and I'm 33. I have a young kid and wife. And so that was the same conversation I had, was that we wanted to make sure that I had the coverage now. And then in 5-6 years, look at the exchange for maybe a permanent product or something down the road when there's more fluid cash in the system. And that was the exact conversation we had. And I found that actually talking to Darren was that he said it was harder for him to illustrate disability or critical illness than it was to convince someone of a term 10 as opposed to term 20. But showing that, he goes, that's where LDA's really stepped up, is I can show those CI, you know, situations, because he's like, you know, 40% of more people are going to need it, but they just don't know it and they don't use it. So it's like, well, people think, well, I'm just wasting money. Now he's like, no, you're not, because this is why. And it's a lot easier to show people.
We always think we're invincible.
Yeah.
People take health for granted all the time.
Well, it's optimism bias, right? Like, as most people suffer from optimism bias. You think it will happen to someone else and never to you.
Yep.
You always think you'll win and somebody else will lose until it's you, right? And then it's a problem. And CI, you know, term 10 looks cheap, because if you take a look historically, and unfortunately I've got to witness this firsthand, you know, it's been a race to the bottom on T10 and T20. Whereas everything else has not been repriced the same way, which is why if you take a look at riders look so exorbitant, right?
Yeah.
Because who's repriced their disability waiver or their FIO or anything like that? Those things don't get repriced. But term 10 in that has dropped so much. And that's the reason why when you go to like different seminars and they're like, oh, you should be selling this rider, it's hard to sell because like the rider costs fractionally more than what the T10 does, right? So that's problematic. And then you've got CI. People are like, well, it's so much more expensive than the life insurance. And it's like, yeah, because you know what? It's priced correctly because the rate of incidence is up. Like, I don't need you to die the whole way. I only need you to die a little bit to get me to sit up. So, you know, it's a funny marketplace. And I definitely, and I know like it's funny, like people will be listening to this, and we had kind of talking about LDA like way down the line, like that wasn't going to be so as front and center in the agenda you guys gave.
Now we got it right front and center. We got you promoting.
What the cool thing? No, like, you know what? I think once again, if you can take something away from this, it's number one that people with systems sell more. People that are clear about their ideal markets know who they're going after. Having a system and having scripting around that system increases your level of confidence and competence. And what happens is your call reluctance or approach reluctance goes way down. When we're at our ultimate high on who we're approaching and we know how we can impact them, we will do more touches and approaches. And as you gain more confidence with that, guess what happens? You do more touches and approaches, right? It's just the way it works.
So where do you think most advisors break down on this sort of thing? Like, is it creating marketing collateral, like actually getting the systems to work together? Like, okay, my renewal letter comes in. How am I going to get like actually putting a process in place? Or where do you see them break down? Is it technical ability, confidence?
So it's right from the beginning. So it's from understanding who they serve. And, you know, you can do similar 7, take a look like who's my most similar clients, like what are their makeups. And then from there, you understand who they are. And you can start to build out your marketing collateral from there. Like, how do we,
but do you think is that where, like, again, like in our experience, if we don't make the template for our advisor to use with the campaign, they probably won't do it. And even then, if we make it for them, sometimes it's still a challenge to go, okay, how do I get this PDF template? How do I get my logo in it? Load it in my CRM, mail it out there, get the link. Like, it is a process, right? Something that's set up to scale. And when you scale and commit to that process, you'll be able to repeat it, get better results. But what's that breaking point? And do you see that changing? Like, are you seeing a younger advisor out there who's, you know, more tech savvy and is sort of on top of it? Or are we just are we teaching old dogs new tricks in some ways?
It's an interesting dilemma. I get the pleasure and I'm fortunate that I get to work with folks on this stuff. So it's funny because the new age guy, he can do all the front of funnel stuff. So like while he gets on, he can create, you know, the marketing piece and he's got this and that. But sometimes they don't like to sell, right? So like they want to just do everything online. They'd rather just set it up so it's like, hey, if you could just buy online and I don't have to really interact much, that would go like really well. And it's like, well, that's not really realistic to what we have going on. So unfortunately, they might get people coming in the front of the funnel, but they're not pushing enough. They're not converting enough, right? Because they just thought it was going to be like instant. With the
it's not just from top just a conversion too, right? Like we've got to move down the funnel. It's their consideration phase. Okay, are we teaching you about life insurance? Do they even know what they don't know, kind of thing? Right. Like again, I think I nagged you a little bit and said, hey, you got a kid, you gotta get life insurance. You got human life, you got capital, basically human lifetime value. Yep. To replace. So
yeah, economic loss, right? Yeah. So like when you work with underwriters enough, like I always look at everything and I'm like, what's the economic loss here? Like, because that's really all the underwriter needs. That's what they need to validate. What is the economic loss of this individual to this specific thing, whether it's a familial unit or a business or a partnership agreement? Yeah. Prove to me what the economic loss is and nothing else, right?
Fund a liability at a lower cost. That is all insurers is supposed to do. That's what Larry told me.
Last day was, how do you argue with Larry? Yeah, I'm like he's 100% correct. So it's systems all the way through. Whether it's you've already got the client in there, what's our ongoing service and system look like? What's our ongoing, like, how do people know they win when they choose us? Like, how do we yardstick them against what we originally set as goals to where they should be? And a lot of this stuff goes, it's kind of like haphazard, right? But the folks that have it down, they happen to also be like the people that are speaking at all the conferences because they realize the value's in the system, right? Like you can't scale without systems, just like you can't fly a plane without manuals, right? And so everything has to be more systematic. And nobody likes this. Look, we're in sales for a reason because we don't want to script. I remember when I first came in the business, I thought scripting was the most unprofessional thing ever. And I am like super, super scripted. I'm constantly writing new scripts all the time because when the chips are down, you'll fall back to what your level of preparedness is. And I'll take the conversation wherever it needs to go. But when I see the opportunity to bring it into where they probably should go, I'm scripted enough to be able to drag it back in. And that's just because I have a framework that I work in. When we do fact finding, I just wrote a thing on this yesterday. You've got to create a framework for that until you don't need the framework put up anymore. Like at which point you walk in with a pad and paper and you know all the questions you want to ask in the sequence in which, and you know why you're asking for financials, because most people don't like to hand that stuff. Most wealthy people don't like to hand you over financials unless you can articulate why you want those. So it's all, once again, it's that's scripting, right? So it's scripting to go into the conversions. It's scripting why you should give me your financials. It's scripting towards why you should do something over something else or why you should consider something in a way that you haven't thought about it. It's all about preparedness. And unfortunately, we come into the business and it's not mandated that we have that preparedness. So
one of the unique things, right, is that you do get the independence to run your practice how you see fit. So as much as, that prescribed system is beneficial to some individuals, they want to create their own system, which fair enough, right?
Well, and there's nothing wrong with that. As long as you've gotten the training and guidance to do that.
Yeah. I mean, I used to give this technology talk that was like, we wouldn't think of a stick as a piece of technology, but when you see an ape using it to measure, the depth of the water, you go, oh, it's a pretty sophisticated piece of technology for an ape to use. So a lot of it is not just around the piece of technology, but the process itself. And again, as much as we want to measure anything today, I think, it would be really hard to measure your efficacy as an advisor if you were changing that process every single time. Again, maybe advisors do need a little more change up because they are a pretty superstitious bunch too, right? Like, oh, well, I wore my red tie today, so I'm going to wear it every time I close an app.
I'm going to say nothing. I brought a mug to a friend's house on the weekend for an Arsenal soccer game, so it didn't work out.
He might be a little bit superstitious.
No, it was kind of more jokey, superstitious, but yeah.
So you just saw something there. We talk about this a lot, like we were talking about kind of the lifetime value of a customer. But when would you, as an advisor, when you talk to advisors, coach them to do that cross sell? Because we have a lot of differing sort of opinion. Like let's say I do sell that client the T10, and that's sort of my foot in the door, something easy, a little less risk than CI, right? Where, medical gets harder to underwrite, et cetera. When do you go back? Like, assuming there's client need, I think that comes obviously at the basis of everything, but, going for that cross-sell, what's kind of the best timing or research? You read a lot of books, so what do the experts say?
I think it's not about the experts, it's about the client, right? So what's the client journey look like? So in just working on a deal recently, it's a joint last to die deal. It's for a state. We're looking at term. That's the stupidest thing you could ever say, right? Joint last to die term. Like, why would you ever sell that? Because they haven't had their liquidity event yet. So right now they're healthy. We know what's coming. We know the X that we're solving for, but we don't have the cash flow to fund it at this point. But what I can't control is I can't control that they have a health event.
Right.
So the controllables within my space at this moment says, you know what, place the term. The idea will be is that somewhere they're both 1 to 3 years away from that liquidity. And so at 1 to 3, we know this advisor will keep on top of them, knowing when did that transact, when does the money hit the bank. The clients already know that they will be converting, and they've seen the pricing on 3 years out, which is the longest duration that we probably run this. And so like that would be a scenario that we know that's going to happen within 1 to 3 years. Right? Everything comes down to your client's journey and how their cash flow is going. So I would say, if you're selling professionals DI, you're calling every year for the FIOs, right? Especially if they're like new grads, because you know that they got in on the new grad program, their incomes are going up. Right. And you want to have touch points, right? With those folks, because it's not the little FIO, right? It's the, oh my God, I just bought this practice and I just signed a deal for like $2 million of lending, right? Well, we should probably have insurance to cover off that risk. So yeah, I think the client journey really dictates it. But I think you need to articulate it. So one of the things I talk about a lot is buy-sell planning. And there's a lot of advisors that do this really, really well. But what I think a lot of them don't do well is evaluate what's the growth like in the company. Is the company in slow growth, right? Good growth, or hyper growth? So slow growth company, you might only have to see them every couple of years to increase their buy-sell agreements. Because the problem is, remember, if I don't see you and you don't increase that and you grow this business by 10% per year and you drop dead, we've got a shortfall in the funding, and that's got to come from cash flow. And you'd rather have your cash flow going back into the business so that way you could continue to get 10% or 20% or whatever that is on your money, right? And so when we understand how somebody's growing their business, that should dictate what our service turnaround is. So if they're in hypergrowth, so we meet a company, I read online this morning, a buddy of mine's company, which we're main name is, but congratulations, grew by like 320% for the last 5 years running or something like that. So each year, 300 kilos. Yeah. It's freaking unbelievable, right? So that's not a company that can afford to wait 5 years, 7 years or whatever to look at their shareholders agreement, because the value of that company is growing exponentially. So I think if we looked at things by like, how are people growing? So like you personally, if your income goes up, let's say you find, some new caveat that drives LDA forward, and Charlie says, oh my God, I need to pay this guy, double what I'm paying him right now. You're underinsured in that moment, right? So I should understand the sort of growth trend that you're going to have as an individual. And I look at people and businesses in the startup phase, growth phase, and mature phase, and everybody's got a trajectory they're running on. So the hotter that trajectory, the more you should be back in touch with your clients about making sure that their economic loss is actually covered for their family. Make sense?
Makes sense.
Sounds like everything you're saying is involving having a plan and a system in place, whether it's meeting with the client the first time, having that interaction about, okay, well, here's what's best for your need, but also establishing that plan that you were just alluding to, and having systems that allow you to do that easily. Mm-hmm. So it's replicated for each client. Thus, also as they evolve in the life cycle of that policy, like that joint last to die term example. Well, we have a plan in place 3 years down the road, but what's the system that's going to help me with that process so where I can be efficient? I find so many advisors I speak to, they're so reactive with these things. They may have that plan, but they don't have the system to replicate that plan. And that's where the wheels fall off the track.
And you can't fault. Look, I was one of those guys. I came in and I was periodically successful as an advisor. And it was because I didn't have a system to run on. I was too busy trying to be all things to all people. If you could fog a mirror, I thought you were my client. I had no clue who I did my best work with. I had no system to follow. I didn't even understand what economic lifetime value of a client was. And this is all, and I had no clue why we were tracking things. Like my manager at the time says, you got to write down how many approaches to how many sits to how many this and that, but he never told me why I was doing it. And so for me, I just thought it was work exercises. Like, it drove me nuts. Now I understand metrics, right? I'm like, you're such an idiot. You should have wrote all this stuff down and known it. And that's the thing is, like, we've got to find ways, and you folks do a great job on helping with that, but we've got to find ways for people to structure the business so that way they can see the opportunities within their books. And it's not, look, I came from a completely unrelated field, right? And so you can't assume that people are going to know pipeline management and cash flow management. Like, you've got to teach that. That stuff is taught, not taught. And so you've got to have the right leadership out there that can help you with this stuff.
I think too, our industry needs to make it a little bit easier to access, right? Like on a national level, no problem getting seats and things like that. As a solo independent advisor, you're not going to get a daily or monthly or weekly recurring feed of your book of business. So like, we can certainly facilitate that for you. But again, when the industry needs to make this sort of stuff more accessible.
I do all this, like, I write a newsletter, and so I do like research and stuff, because I'm like,
where can we subscribe to your newsletter?
It's on Gryphin. So it's a Gryphin newsletter. It's funny. Like, somebody will ask you a question, and I'm like, you know what? That's a good question. I'll answer it. But I'm like, this may vary from carrier to carrier. So then that leads me down a rabbit hole of starting to call carriers. So like recently somebody said, somebody said to me, did you know that if you choose contingent beneficiaries, if you have secondary beneficiaries and the primary dies, it doesn't automatically roll to the secondary beneficiaries? And I'm like, okay. So I'm like, is that a joint first scenario? Is that like any policy? Like, let's stretch that out a bit. So find that out. So I start reaching out to carriers, and it's like, some carriers, that's an automatic thing. When the primary dies, the secondaries become the primary. Okay, cool. Right? But that's not with every carrier. Some carriers are like, no, you have to repaper this, right?
That was where the whole per stripes per capita conversation,
Yes. I posted that, right? Yes. Because that and like the amount of people that had never heard per stripes per capita, like, ever, like, I was like, oh, okay. Like, this is maybe a bigger topic than what people realize. So I have a mother, it's funny, I made this call last night. We had, my family was over. My mom is got early dementia, and my father has a policy on her, and I think I was pretty certain he was the beneficiary of it. And so I call him up and I say, hey, Dad, I need you to make me irrevocable beneficiary, or my sister irrevocable beneficiary of the contract. And he goes, well, why? And I said, well, you'll probably predecease Mom, and if you do, we got a problem, because she's the contingent owner and you're the beneficiary, and she will not have capacity at that time in which to make beneficiary changes. So I said, this is why I want to do this. And he goes, I'll just make you contingent owner. I go, no, that's a disposition for tax purposes. I can have all the rights and control of the contract. I can pay the premium as an irrevocable. And I said, like, if she passed away before you, like, I'll just hand you over the money. Like, I don't need the money. I'm doing this strategically based on the reality of what we have. And I was thinking afterwards, I was talking with my wife, and I said, I wonder how common this scenario is, and people don't realize what's going to happen coming down the pipe. And so, it's once again,
it was an interesting conversation. It was something I didn't think was going to spur that much activity. I think I posted the Modern Family breakdown of the two families, how it would actually be dispersed, right? But again, I think it turned a little bit too young on the age.
Yeah, well, and it's these are the sorts of, you can't get at this expertise anymore. And unfortunately, so this breaks down like the whole idea. Like every company has different ways of doing things.
Yeah.
And that's a problem. And then you got all this legacy stuff, because I was trying to look for a policy that nobody can find. But then mine,
as we try and build a product master, right, for a lot of the in-force stuff, and even just combining, like, survey is one thing, that's great. But as you know, you're like, you and I would know if I said, oh, if client's a cigar smoker, you go, well, if he likes cigars, there's only one company I'm going with, which isn't reflected anywhere, really.
Right.
Like, you've got to search around or go, oh, well, if they have this condition, it's definitely this carrier. We see it all the time in those forums. Vapor, right?
Get a vapor that's not doing like a nicotine, just e-juice.
Yeah.
There's only one carrier that will take that as standard non-smoker, right? So
who's that for our audience?
It's Benevac. Okay, it's Benevac. Now, but you got to make sure that the person's not lying to you, that there isn't nicotine.
Yeah.
I mean, and you'll get people say, well, what would be the point? Then it's like, well, that's what happens is people switch to vaping to try and quit the smoking, and then they cut out the nicotine, but they still like the habit and the social aspect of it, so they continue doing it. I did not vape, just for the record, so I really don't understand that fully, but
it was good to know the provisions, like even like Foresters, like knowing that it's 2 years of non-smoker race before then you get smoke. I think that's a great contractual option to have. And there's a number of really good ones. Someone was telling me a great whole life one on what was it? It was Matt Fishman was telling me kind of Serenia.
Yeah.
And their whole life, they've got a really interesting feature to convert. And basically, I don't want to say it now, but it's a really interesting whole life feature. Cool. I don't want to get it wrong.
Yeah, that was just my whole life for everyone. Last month's newsletter, I was working on a deal, older business owner. He's got money trapped in a corp they will never need. Like, they literally have, like, when you're a young agent, you hear people say this, you're like, oh my God, I can't wait to one day find a client. But then once you're there in that space, it's crazy the amount of wealth that you start to see, and you think there's no way it's going to get bigger. And then you get to one that's just way bigger. So this is a case where it's a 70-something-year-old individual, has a holding company that they made some money in. It's just sitting there. They have no need for it. And they're like, well, what can I do with this? Like, how do I get this out to my, like, I don't need it because, my kids, is there something better I could be doing with it? And, they're also risk adverse. So the money's sitting there in mostly fixed income, which is the worst place for it to be inside of a court. Oh, yeah. So anyways, I started going down. So this is kind of how I started breaking down product, right? And I have my own kind of methodology on how I do that, but I'm going through it. And so we're looking at something. It's got to be 10-pay. It's got to be guaranteed. So, that's a pretty simple thing. You could go into everybody's software. You could go into LDA and just plug all this stuff in. And that would work great. And then I'm like, at the last minute, I'm like, Foresters has got a 10-pay. Let me see what theirs looks like. And this is not a shot at the Foresters people. I love you. But, like, they would, in that space, they would not usually line up, right? Because usually it's like their cash values are a little weaker. Their death benefit. Usually when you think of their product, you think of enhanced, not paid up additions. And so, I run it in and I'm like, okay, what is this? And my gosh, it's like, wow, death benefit wise, they're running away from everybody. Okay. So they're top of the death benefit. Then I couldn't figure out their software is ugly. Your software is ugly. And so, I couldn't find the tax stuff. Right. So I'm like, okay, well, their premium's very close to Equitables. Their face amount's fairly close. I'm going to assume it's got to be similar to Equitables. Let me take a look. So, okay, fine. I look at them like, okay, they're better, but not much better. But then I get a hold of the right person at Foresters, run it through. Because their cash value is so low, their grind on the adjusted cost base is so much better because there's more net amount at risk. This thing is an absolute smoke show. For people over 60, like I've run a few different cases now, for corporates looking for 10-pay on redundant assets, over 60, it's crazy the CDA inclusion that you get. Like it will absolutely demolish your 5-6% GIC alternatives. Like,
so this is where you need to go back to your system, load up your clients in LDA, pump in everyone whose age and birthday meets that range.
Yep.
Start making some phone calls.
Yeah, you know what? And, we've got a couple like live deals. One's just being written up today, I think. That's like $100,000 premium, which would be way outside of their normal probably sale range. But you know what? The product fits well. So it's like small little things like that. You find these caveats that can make such a big difference in a case. And, this was a case of, tax efficiencies, right? Tax efficiencies just work really well.
Thank you for listening to this part 1 of our conversation with Brent Swatuk, Charlie Conron, and John Jarby. We look forward to releasing the second episode in the coming weeks and sharing that together with you. Before we end today, I again want to encourage you to join our LinkedIn group, Policy Pod by LDA, as well as if you've never tried life design analysis before and want to see how it will affect your life insurance practice, you can sign up at lifedesignanalysis.com/sign up. That's lifedesignanalysis.com/SIGN-UP. Before I go, I would like to remind you that we made this podcast as a place to foster conversations that matter to you, our listeners. With that said, if there's a topic or an area of expertise that you would like to come onto the podcast to discuss with us or would like us to explore, I want to hear from you. Connect with me on LinkedIn or send me an email at marketing@lifedesignanalysis.com to lend your insights and experience to the conversations on PolicyPod. Thank you again for joining us today. We look forward to having you in our next conversation. Have yourself a wonderful day.